All right, you know that feeling, right? Tax season hits. You're looking at this pile of financial documents, brokerage statements, maybe a Form 1099-B, a 1099-DIV over here, and it just feels a bit overwhelming.
Oh, completely. Like trying to assemble furniture with instructions in another language sometimes.
Exactly. You've got investment gains, maybe some losses, but how do you actually turn that data dump into, actionable insights? And more importantly, how do you make sense of it to maybe save some actual money?
That really is the core challenge. It's so easy to feel lost in the forms. But what many people don't quite grasp is that understanding this stuff, capital gains, losses, it isn't just about ticking boxes for the IRS.
Right.
It's actually about finding real ways to be much more tax efficient with your investments. There are opportunities hidden in there.
Which is exactly why today we are taking a deep dive into what often feels like, well, the Bermuda Triangle of the Form 1040 packet, Schedule D, the form for capital gains and losses. And this isn't just a reporting chore, believe it or not. It's more like a roadmap. If you
Well,
understand the rules, you can find these crucial ways to save on taxes, maybe even tweak your investment strategy going forward.
our mission today really is to break this complex form down. We're going item by item. We'll look at the core ideas, the other forms that connect to it, and that's key, and really highlight those tax-saving strategies and exclusions that, honestly, a lot of people just overlook.
Think of it as a shortcut, maybe, a way to master your investment tax reporting and find those little nuggets of tax efficiency.
Exactly. A guided tour through the jungle of tax forms.
So I'll be guiding us through the maze of instructions, pointing out what seems interesting, what's really critical, and where those aha moments might be hiding.
And I'll be here to, connect the dots, explain the why behind these rules, and hopefully make sure you walk away feeling not just informed, but actually equipped, ready to tackle this with more confidence.
Okay, let's do it. Let's unpack Schedule D. Where do we even start? What is this form fundamentally for?
So at its absolute core, Schedule D is where you calculate your overall net gain or loss from selling or exchanging what the IRS calls capital assets.
Capital assets.
Right. It pulls together all those individual transactions you might have had during the year, selling stocks, bonds, maybe even your house. And it gives you that final summary number, your total capital gain or loss.
But it's not usually just Schedule D by itself, is it? I feel like I remember it needing info from elsewhere.
You're absolutely right. It's almost never completed in isolation. Think of it more like a summary page, a hub. It relies really heavily on information flowing in from other forms.
Okay, so which forms are we talking about? Is there a main one?
The big one, the primary feeder form you absolutely have to know about is Form 8949. Its title is Sales and Other Dispositions of Capital Assets.
8949. Got it.
And this is critical. You generally must complete Form 8949 before you can fill in most of the main lines on Schedule D. We're talking lines 1B, 2, 3, and then on the long-term side, lines 8B, 9, or 10.
So Form 8949 is where all the individual sales get listed out, like every single stock trade.
Exactly. It's the detailed breakdown. You list each transaction there, the sale date, purchase date, proceeds, cost basis. Then Schedule D just takes the totals from Form 8949.
Okay, like the itemized receipt versus the final bill total. Makes sense. You mentioned other forms too, though, beyond 8949.
Oh, yes. Depending on what you've been up to financially, a whole host of other forms can feed into Schedule D. It really depends.
Like what? Give me a few examples.
Sure. So if you get undistributed capital gains from, say, a mutual fund,
Yeah.
that info comes over from Form 2439. If you sold property using an installment sale method, where you get payments over time, that involves Form 62502.
Okay.
Then there's Form 4797, sales of business property.
Hmm.
This handles assets used in a trade or business, like depreciable equipment or maybe rental real estate. That's a big one.
Business property. Right.
Wow.
Not personal stuff.
Correct. And there are others too. Form 4684 for casualties and thefts, Form 6781 for certain complex financial contracts, Form 8824 for like-kind exchanges, swapping one investment property for another.
Wow. Okay. It really is a hub.
It is. And even newer things like Form 8997 for investments in qualified opportunity funds. Each one captures a specific type of transaction or a special tax rule, and the results eventually find their way onto Schedule D.
So Schedule D pulls info from 8949 and maybe these other specials forms. But does Schedule D itself do anything unique? Are there specific things you report only on Schedule D?
Good question. Yes, there are a few key things Schedule D handles directly. First, as we'll get into later, it's where you report certain transactions using a simplified method, lines 1A and 8A, where you might not even need Form 8949. That's a nice shortcut.
Oh, interesting.
Second, it's the designated spot for reporting capital gain distributions. These often come from mutual funds or REITs, reported to you on Form 1099 DIV or Form 2439. They don't go directly onto the main Form 1040. They land on Schedule D, line 13 specifically. And third, and this is really important for long-term tax planning, Schedule D is where you report your capital loss carryovers from the previous tax year. So if you had more losses than you could deduct last year, you bring that leftover loss forward onto this year's Schedule D to potentially offset gains this year.
Ah, the carryover. That's a big tax saver, potentially. Okay, we've mentioned capital assets a few times. Let's define that. What exactly is a capital asset, according to the IRS? It's not just stocks, right?
Right. Definitely not just stocks and bonds. That's a common mistake.
Hmm.
The definition is actually quite broad. Generally, most property you own and use for personal purposes or hold for investment is a capital asset.
So, like my house, my car.
Yes, exactly. Your personal residence, your furniture, your car, those are capital assets. Also things like artwork or collectibles, of course, stocks and bonds too. If you sell any of these things at a profit, that gain is typically a capital gain.
But the key seems to be what isn't a capital asset, because that gets treated differently for taxes.
Precisely. Understanding the exclusions is crucial because those items follow different rules, often leading to ordinary income or loss treatment, not capital gain or loss. And that can have a big impact on your tax rate.
Okay, lay it on me. What's not a capital asset? Where does the IRS draw the line?
All right, here are the main categories the IRS excludes. First, inventory. Any property you hold primarily for sale to customers in your ordinary trade or business. So if you're a retailer, the goods on your shelves aren't capital assets.
Makes sense, like a car dealer's cars.
Exactly. Second, accounts or notes receivable you got from selling inventory or providing services in your business. Third, depreciable property used in your trade or business, and real estate used in your trade or business. This is a really important one.
So my rental property isn't a capital asset, even though I own it.
Generally, no. If it's used in your rental business and you're depreciating it, its sale is usually handled on Form 4797, not primarily Schedule D, and some of the gain might be recaptured as ordinary income. Your personal home is a capital asset, but business or rental real estate gets different treatment.
Okay, that's a critical distinction. What else is excluded?
Fourth, intellectual property like copyrights, patents, literary or musical compositions, letters, memos, things like that, if they were created by your own personal efforts, or if you received them as a gift from the creator in a way that your basis is the same as the creator's.
So if I write a book, the copyright isn't a capital asset initially.
Typically, no. Selling it would generate ordinary income. However, there's a really interesting tip here for musicians and composers.
Oh, a loophole.
Not quite a loophole, but an election. You can elect to treat certain musical compositions or copyrights that you sell or exchange as capital assets.
Really? So you could potentially get the lower long-term capital gains rates instead of ordinary income rates?
Potentially, yes.
Oh.
It's an elective choice, not automatic. You need to check the details in Publication 550, but it's a specific provision that can be a significant tax saver for creators in the music industry.
Wow, that is a hidden gem. Good to know. Any other major exclusions?
Just a couple more quick ones. U.S. government publications you receive for free or less than the normal price. Certain commodities, derivative financial instruments held by dealers, and supplies you regularly use in your trade or business.
Okay, so the list of what isn't a capital asset is pretty specific and often business-related. This all sounds like it hinges on knowing your numbers accurately, especially your starting point. Let's talk about basis. Why is it so fundamental?
Basis is, well, it's everything for calculating gain or loss. It's essentially your investment in the property for tax purposes. Usually it's what you paid for it, the cost.
So sale price minus basis equals gain or loss.
That's the basic formula, yes. Sale price minus your adjusted basis. If you don't know your basis accurately, you simply cannot calculate your taxable gain or your deductible loss correctly. You could end up paying way too much tax on a gain, or worse, missing out on a loss deduction you're entitled to.
Which means meticulous records are non-negotiable.
Absolutely critical. You can't just guess. Your records need to show, at a minimum, the original purchase price, including any commissions or fees you paid to acquire the asset.
But you said adjusted basis, so it can change over time.
Yes, it often does. Your basis can increase, for instance, if you make significant capital improvements to a property. The cost of those improvements adds to your basis. Think adding a room to your house.
Okay.
And it can decrease. If you took depreciation deductions on a business asset, that reduces your basis. Receiving non-dividend distributions on stock, sometimes called a return of capital, reduces your basis. Even things like stock splits change your per-share basis. You have to track all these adjustments.
That sounds like a lot to keep track of, especially over many years.
It can be, which is why starting good habits early is key. Keep purchase confirmations, records of improvements, statements showing distributions. It pays off at tax time.
And I heard something about consistency, especially with inherited property. There's a rule about matching the estate value.
Yes, that's an important point for anyone who inherits assets. If you receive property from an estate, and the executor provides you with a Form 8971 and its Schedule A, which reports the final estate tax value of the asset, you generally must use a basis that's consistent with that reported estate tax value.
So you can't just decide on a different basis number yourself.
No, this rule ensures consistency between the estate tax return and the heir's income tax reporting. It prevents using one value for estate tax and a different, perhaps more favorable, basis for calculating gain when the heir sells it. Publications 551 on basis of assets and 550 on investment income have much more detail on these rules.
Okay, crucial details there. So we know what a capital asset is, mostly, why basis is key, and the need for records. Now let's hit one of the biggest concepts for tax impact, short-term versus long-term. Why is this dividing line so important?
This is probably the most important distinction for how your gains are ultimately taxed. It all comes down to the holding period, how long you own the asset before selling it.
And the magic number is
1 year. If you held the capital asset for 1 year or less, any gain or loss is short-term. If you held it for more than 1 year, the gain or loss is long-term.
more than 1 year means 1 year and a day, basically.
Exactly. 1 year and a day makes it long-term.
And why does that matter so much for my tax bill?
Because the tax rates are usually very different. Short-term capital gains are typically taxed at your ordinary income tax rate, the same rate as your salary or business income, which can be quite high.
Okay.
But long-term capital gains often qualify for preferential tax rates. These rates are usually 0%, 15%, or 20%, depending on your overall taxable income. For many people, the long-term rate is significantly lower than their ordinary income rate.
So holding an investment for just over a year instead of just under could mean paying, say, 15% tax instead of maybe 24% or 32% or even more.
Precisely. That difference can be substantial, especially on large gains. It's a major tax-saving concept baked right into the system, rewarding longer-term investment.
Are there any exceptions? Is it always just 1 year?
Mostly, yes. The 1-year rule is standard. But there are a few wrinkles. For instance, there's a special rule for certain applicable partnership interests, often related to carried interests in investment funds. For those, the holding period to get long-term treatment is actually more than 3 years, not 1.
Ah, okay. More complex stuff for fund managers, perhaps.
Right, it's specific. But for most individual investors dealing with stocks, bonds, or personal assets, that more than 1-year rule is the key takeaway for long-term treatment.
Fantastic. Okay, foundational concepts covered. Let's shift gears now and navigate some specific transactions and really focus on those tax-saving strategies you mentioned. How can we leverage the rules? Let's start with something common. Capital gain distributions. Where do they come from?
Right, these pop up frequently if you own mutual funds or REITs real estate investment trusts. These funds buy and sell assets throughout the year. When they realize net long-term capital gains on their investments, they're required to distribute those gains to their shareholders. That's what a capital gain distribution is.
So it's the fund's long-term gain being passed through to me.
Exactly. And here's a key distinction. If the fund realizes short-term capital gains, those usually get paid out as ordinary dividends, not capital gain distributions. They're treated differently.
Why is that distinction important?
Again, it comes down to tax rates. Those ordinary dividends are taxed at your ordinary income rates, while the long-term capital gain distributions typically qualify for the lower long-term capital gains rates.
Okay, so how do I report these distributions? Do I need to track the fund's trades?
No. Thankfully, you don't need to track the fund's internal activity. The fund does that. You'll receive a Form 1099 DIV, and Box 2A will typically show the total amount of capital gain distributions paid to you.
Box 2A on the 1099 DIV.
Got it. You take that amount from Box 2A and enter it directly onto Schedule D, line 13. And here's an interesting point. It's treated as long-term regardless of how long you personally owned the shares of the mutual fund. If the fund held the underlying assets long enough, the distribution is long-term for you.
That simplifies things. What about the other boxes in that section of the 1099 DIV, like 2B, 2C, 2 paint?
Could I? Those boxes signal potentially more complex situations related to the capital gain distribution. Box 2B relates to unrecaptured Section 1250 gain, which involves depreciation on real estate and might require a separate worksheet. Box 2C points towards gain potentially eligible for the qualified small business stock, QSB exclusion, a huge tax saver we'll discuss. And Box 2B relates to gains taxed at the 28% rate, like collectibles.
So those boxes are flags for dig deeper here.
Exactly. They tell you that a portion of your Box 2A distribution might need special treatment or calculation using specific worksheets.
Okay. Now let's talk about maybe the biggest tax-saving opportunity for many people. Selling your main home, you can exclude a massive amount of gain, right?
Absolutely massive. This is one of the most generous exclusions in the tax code. For many homeowners, they might sell their house for a large profit and pay absolutely zero tax on it.
Zero tax. How does that work? Do you even need to report it?
Often, you don't even need to report the sale on your tax return if you meet the exclusion tests, and your entire gain is covered by the exclusion amount. It's a huge simplification and tax saving.
So when do you need to report it?
You generally have to report the sale on Form 8949 if you can't exclude all the gain, maybe your profit is larger than the exclusion limit, or if you received a Form 1099 EMS, which is a form reporting proceeds from real estate transactions. Brokers often issue these automatically.
Okay, so what are the exclusion limits? How much gain can be tax-free?
For single filers, you can exclude up to $250,000 of gain. If you're married filing jointly, that amount doubles to $500,000.
$500,000 potentially tax-free? That's incredible.
It really is. And a helpful detail for married couples. Only one spouse needs to meet the ownership test, although generally both need to meet the use test.
Okay, the tests. What are the key tests you have to meet to qualify for this amazing exclusion?
There are two main hurdles, or tests. Test 1 is the ownership and use test. You need to have owned the home for at least 2 years during the 5-year period ending on the date of sale. And you need to have lived in the home as your main home for at least 2 years during that same 5-year period.
2 out of the last 5 years for both owning and living there. Do they have to be the same 2 years?
No, they don't have to be continuous or the same exact periods, just that you meet each 2-year requirement within that 5-year window looking back from the sale date.
Okay, that's test 1. What's test 2?
Test 2 is the no prior exclusion test. Basically, you generally can't have used this home sale exclusion for another main home sale within the 2-year period ending on the date of the current sale. This prevents people from, flipping main homes every year tax-free.
Right, one exclusion every 2 years, basically. What if you don't quite meet those tests? Maybe you had to move for a job after only 18 months? Are you totally out of luck?
Not necessarily. And this is another great feature. You might still qualify for a reduced exclusion if you sold the home because of a change in place of employment, for health reasons, or due to certain unforeseen circumstances defined by the IRS.
How does the reduced exclusion work?
Instead of the full $250K or $500, your maximum exclusion is prorated based on how much of the 2-year ownership and use requirements you did meet. So if you met them for 18 months out of 24, which is 75%, you might get 75% of the full exclusion amount. Publication 523, Selling Your Home, has all the specifics.
That's really helpful flexibility. Are there any other special circumstances for test 1, the ownership and use part? What about military families who move frequently or surviving spouses?
Yes, definitely. For surviving spouses, if your spouse passed away before the sale, you might still qualify for the full $500,000 exclusion if you sell the home within 2 years of their death and you meet certain conditions related to the ownership and use tests just before they passed away and you haven't remarried.
Okay. And for military or foreign service?
This is a big one. For members of the uniformed services, the foreign service, the intelligence community, or even Peace Corps volunteers on qualified official extended duty, you can elect to suspend the 5-year test period for ownership and use.
Suspend it. How does that help?
It means the time you spend away from the home on that official duty doesn't count against the 5-year look-back period. You can suspend it for up to 10 years. This makes it much easier for those serving overseas or deployed frequently to still meet the 2 out of 5-year requirement when they eventually sell.
Can you give a quick example?
Sure. Let's say you bought a house,
Yeah.
lived in it for 3 years, then you go on assignment overseas for, say, 7 years. Then you come back and sell the house a year later. Normally, in the 5 years before the sale, you only live there for 1 year. But if you suspend the 7 years you were away, the IRS effectively ignores that time. They look at the period before your assignment where you did live there for 3 years, allowing you to meet the use test.
That's a really important provision for service members. Okay, so let's say you qualify for the exclusion, but you do have to report the sale. Maybe you got a 1099-S. How do you show the exclusion on Form 8949?
Right, so you report the sale details proceeds basis on Form 8949, Part 1 for short-term, Part 2 for long-term, usually Part 2 for a main home. The key is in columns F and G. You enter code H in column FH for home sale exclusion. Then in column G, which is for adjustments, you enter the amount of gain you're excluding as a negative number in parentheses.
So if you have a $300,000 gain and are excluding $250,000.
You'd put $250,000 in column G. That effectively subtracts the excluded amount, leaving only the taxable portion, $50,000 in this case, in column H.
What about a loss on your main home? That's usually not deductible, right? But if you get a 1099-S, you still report it.
Correct on both counts. Losses on personal use property, including your main home, are generally not deductible. But if you receive a Form 1099-S for the sale, the IRS knows about the transaction, so you must report it on Form 8949. You'd use code L for non-deductible loss, which we'll touch on more.
Okay, that brings us nicely to that broader category. Capital assets held for personal use, like a vacation home, jewelry, art. Gains are taxed, but losses are tough luck.
That's the gist of it, yes. If you sell personal use property for a gain, that gain is a capital gain, short-term or long-term, and it's taxable. You report it on Form 8949.
But if I sell my boat at a loss, or that vacation cabin?
If you sell personal use property at a loss, that loss is generally not deductible. It doesn't offset your other capital gains or income. This catches a lot of people off guard, especially with things like cars or boats that almost always sell for less than you paid.
So even if it's a big loss on, say, a vacation home, and I get that Form 1099-S, I still report the sale but get no deduction. How does that work on the form?
Exactly. You have to report it if you got a 1099-S. On Form 8949, you'll report the proceeds and basis. Then in column F, you enter code L, which signifies a non-deductible loss. In column G, for adjustments, you enter the amount of the non-deductible loss as a positive number.
The positive number? Why?
Because adding the positive loss amount in column G cancels out the negative loss calculated from columns D and E, resulting in zero gain or loss in column H for tax purposes. So if you sold that vacation home with a $100,000 loss, you'd put $100,000 as a positive number in column G. It tells the IRS, yes, this transaction happened, here's the loss, but I know it's not deductible.
Ah, okay. The positive adjustment zeroes it out. Clever. This gain is taxable, loss is not rule for personal assets is a really key takeaway. Now let's talk about capital losses more generally, the ones that are potentially deductible, like from selling stocks. How do you make the most of those?
This is a really important area for tax saving. When you have capital losses from investments, you first use them to offset any capital gains you have in the same year. Short-term losses offset short-term gains first, long-term losses offset long-term gains first. Then, if you still have losses left over in one category, they can offset gains in the other category.
So losses cancel out gains first. What if you have more losses than gains?
If, after netting all your gains and losses, you end up with an overall net capital loss for the year, you could deduct up to $3,000 of that loss against your other types of ordinary income like your salary, interest income, etc.
Only $3,000 against ordinary income, even if my net capital loss was, say, $10,000.
Yes, the limit for deducting capital losses against ordinary income is $3,000 per year, $1,500 if you're married filing separately.
So what happens to the remaining $7,000 loss in that example? Does it just vanish?
Absolutely not, and this is the crucial long-term benefit. Any net capital loss exceeding the $3,000 annual limit is carried forward to future tax years. This is the capital loss carryover we mentioned earlier.
So I can use that leftover $7,000 next year?
Yes. You carry it over to the next year, where it can be used to offset capital gains in that year, or, again, up to $3,000 of ordinary income if you still have losses remaining. You can keep carrying forward unused losses indefinitely until they're all used up.
That's a really valuable feature. It cushions the blow of investment losses over time. How do you keep track of this carryover?
You need to calculate it each year you have a carryover. The instructions for Schedule D include a capital loss carryover worksheet. You use your current year's Schedule D and potentially your Form 1040 information to figure out the amount and character, short-term versus long-term, of the loss to carry to the next year. You keep this worksheet for your records. It's essential for filing accurately in the following year.
Good record-keeping strikes again. Okay, we talked about non-deductible losses on personal assets. Are there other situations where a loss might be disallowed? I think I remember something about selling to family members.
Yes, that's another important area. Sales between related parties. The IRS has rules to prevent people from generating artificial tax losses by selling assets at a loss to someone closely connected to them, only to have that person potentially sell it back later or keep it within the family or controlled group.
So you can't just sell losing stock to your brother to claim the loss.
Generally, no. You cannot deduct a loss from a sale or exchange of property directly or indirectly between certain related parties.
Who counts as a related party for this rule? Is it just immediate family?
It includes immediate family, brothers, sisters, spouse, ancestors, parents, grandparents, and lineal descendants, children, grandchildren. In-laws are generally not considered related parties for this rule, interestingly.
Okay. Who else besides family?
It also includes relationships like an individual and a corporation, where the individual owns more than 50% of the stock, a grantor and fiduciary of a trust, fiduciaries of two trusts if the same person is the grantor, a fiduciary and beneficiary of a trust, an executor of an estate and a beneficiary, with some exceptions, and an individual and a tax-exempt organization controlled by that individual or their family. It's quite broad.
So even if it's a legitimate sale at a fair market price, if it's to my sister and it's at a loss, I can't deduct it.
Correct. The loss is disallowed purely because of the relationship between the buyer and seller.
How do you report that kind of non-deductible loss on Form 8949? Is it the same L code?
Yes, exactly the same procedure as the personal use non-deductible loss. You report the transaction details, proceeds, basis. You enter code L in column F, and you enter the amount of the disallowed loss as a positive number in column G to zero out the loss for tax purposes in column H.
Let's use that example from the instructions. Sold land, held 5 years investment to my brother for $10. My basis was $15, so a $5 K loss.
Right. Because it's your brother, a related party, that $5,000 loss is non-deductible. On Form 8949, Part 2, long-term, you'd show $10,000 proceeds, $15,000 basis, code L in column F, and then $5,000 positive in column G. Column H, gain loss becomes zero.
Got it. Transparency, but no deduction. Now, another way losses can be disallowed involves something called a wash sale. This sounds like trying to wash away taxes.
Kind of the opposite. The rule prevents you from washing away taxes prematurely. A wash sale occurs when you sell stock or securities at a loss.
Okay.
And then, within a specific window, 30 days before the sale or 30 days after the sale, a 61-day period in total, you do one of a few things.
Okay.
1, you buy substantially identical stock or securities. 2, you acquire substantially identical stock or securities in a fully taxable trade. 3, you acquire a contract or option to buy substantially identical stock or securities. 4, or crucially for retirement planning, you acquire substantially identical stock or securities for your IRA or Roth IRA.
So if I sell stock ABC at a loss on March 15th, but then I buy stock ABC back on April 1st, that's a wash sale.
Yes, that's a classic example, because you bought it back within 30 days of the sale, generating the loss.
And the consequences.
The consequence is that you cannot deduct the loss from that March 15th sale on your current tax return. Unless you're a professional dealer in securities, the loss is disallowed.
Why does the IRS care if I sell and buy back quickly?
They see it as you haven't truly changed your economic position. You sold at a loss, but immediately reestablish your position in the same security. The rule prevents taxpayers from harvesting losses for tax deductions without actually exiting the investment for a meaningful period.
Is the loss gone forever then?
No, thankfully not. This is important.
Yeah.
The disallowed loss from the wash sale isn't permanently lost. Instead, it gets added to the basis of the replacement shares you bought.
Ah, so it increases the cost of the new share.
Exactly. Which means when you eventually sell those new shares, your taxable gain will be lower, or your deductible loss will be higher because of that increased basis. So the wash sale rule essentially defers the loss deduction rather than eliminating it.
Okay, that makes sense. How do I report a wash sale on Form 8949? Does my broker tell me?
Your broker might. Form 1099-B often reports wash sale loss disallowed amounts, especially for covered securities, where the broker tracked your basis. Box 1G on the 1099-B might show this.
But even if it's not on the 1099-B?
Even if it's not explicitly flagged by your broker, maybe you bought the replacement shares in a different account, the rule still applies. You are ultimately responsible for identifying wash sales. On Form 8949, you report the transaction, enter code W in column F, and then enter the amount of the disallowed loss as a positive number in column G. Again, the positive number adjusts the transaction's outcome on the form.
Code W for wash sale. Got it. This really highlights needing to track dates carefully. Okay, let's shift to something quite different. For people who are very active in the markets, there's a potentially huge distinction between being an investor and a trader. Why does this matter so much for taxes?
This distinction is night and day in terms of tax treatment. It's one of the most significant classifications for active market participants. But the bar to qualify as a trader in the eyes of the IRS is very high.
What does it take to be an official trader? buying and selling stocks every day.
It's more than just frequency. The IRS looks for all of these factors. You must be seeking profit from daily market movements and prices, not from long-term appreciation, dividends, or interest. Think very short holding periods. Your trading activity must be substantial. There's no exact number, but it implies significant volume and capital. And the activity must be carried on with continuity and regularity. It needs to look like a business, not a hobby or occasional speculation.
So someone checking their portfolio daily and making a few trades a week is probably still just an investor.
Almost certainly, yes. If your goal includes dividends or long-term growth, or if the activity isn't your primary source of income or doesn't occupy significant time, you're likely an investor. Most people who manage their own portfolios are investors.
But for those rare individuals who do meet the strict trader definition, what's the big tax advantage? There's some kind of election they can make.
Yes, the holy grail for qualifying traders is the mark-to-market election under Internal Revenue Code Section 475FE. This is a formal election you make with the IRS.
Mark to market, what does that do?
If a qualifying trader makes this election, it completely changes how their trading gains and losses are treated. Instead of being capital gains and losses subject to Schedule D rules,
Yes.
they get to treat all gains and losses from securities held in connection with their trading business as ordinary income or loss.
Ordinary income or loss.
Not capital, correct. And this includes securities they're still holding at year-end. Those are treated as if they were sold for their fair market value on the last business day of the year they're marked to market.
Why is ordinary loss treatment so much better than capital loss?
This is the huge advantage. Remember how investors are limited to deducting only $3,000 of net capital losses against ordinary income each year? A trader who has made the mark-to-market election has no limit on deducting their trading losses. If they have a net ordinary loss from trading, they can use it to offset any other ordinary income. They have salary, business income, anything potentially wiping out a huge chunk of their tax liability in a down year.
Wow, that's a massive difference compared to the $3,000 limit. Any other benefits?
Yes. Traders with this election can generally deduct their business expenses, like margin interest, software, data feeds, hunter office, if applicable, on Schedule C, profit or loss from business, just like any other sole proprietor. Investors usually have to deduct investment interest and expenses on Schedule A as itemized deductions, which are subject to limitations and might not even be deductible if they take the standard deduction.
So better expense deductions, too. Is there any downside? What about self-employment tax?
Generally another plus. These ordinary gains and losses from trading under the mark-to-market election are typically not subject to self-employment tax.
That sounds incredibly powerful for someone who qualifies. How do you make this election? Is it easy?
The election itself involves attaching a statement to your tax return. But the timing is strict. Generally, you have to make the election by the original due date, not including extensions, of the tax return for the year before the year you want it to become effective.
So to have it apply for 2024 taxes, I would have needed to make the election by April 15th, 2024, the 2023 return due date.
That's generally correct, yes. You have to plan ahead. Once made, it applies to all subsequent years unless revoked, which requires IRS consent, and it applies to all securities held in connection with the trading business.
What if a trader also holds some stocks long-term for investment? Does the election force those into ordinary treatment too?
No, there's a provision for that. If a trader wants to hold specific securities for investment, long-term appreciation, dividends, they must clearly identify those securities as held for investment on their records on the day they acquire them. Perhaps keep them in a completely separate brokerage account labeled investment. Those properly identified investment securities are then excluded from the mark-to-market rules and follow the standard capital gain loss rules on Schedule D.
Okay, that allows for segregation. Fascinating stuff. Truly a different world for qualifying traders. Let's shift to another potentially massive tax break, this time focused on investing in small companies. The Qualified Small Business Stock, QSB stock, exclusion under Section 1202.
Yes, Section 1202 is incredibly powerful. It's designed specifically to encourage long-term investment in new ventures and small, growing USC corporations by offering a significant exclusion on the capital gains when you eventually sell that stock.
How significant? What kind of exclusion are we talking about?
Potentially, up to 100% of the gain can be excluded from federal income tax, completely tax-free.
100% tax-free gain. That sounds almost too good to be true. What's the catch? There must be requirements.
Oh, there are definitely requirements, and they are strict. The absolute biggest one is the holding period. You must have held the QSB stock for more than 5 years to qualify for the exclusion.
More than 5 years, okay. That encourages long-term commitment.
Yeah.
What else determines the exclusion amount? Does it depend on when you bought the stock?
Yes, the percentage of gain you can exclude depends on when you originally acquired the QSB stock. If you acquired it on or before February 17, 2009, the exclusion is generally 50% of the gain. If acquired after Feb 17, 2009, but before September 28, 2010, the exclusion is 75%. And the big one, if acquired after September 27, 2010, the exclusion is 100%.
So for stock acquired in recent years, it's potentially a full 100% tax-free gain after holding for 5 years.
That's right. Up to certain limits, of course, but yes, potentially completely tax-free federally. This is huge for founders, early employees receiving stock options, and venture capital investors.
Okay, let's get into the definition. What qualifies as qualified small business stock? What conditions does the stock and the company have to meet?
This is where you need to be really careful. All of these conditions generally need to be met. 1, it must be stock in a domestic C corporation. S corporation stock does not qualify.
C Corp only. Got it.
2, the stock must have been originally issued after August 10, 1993. 3, the corporation must have been a QSB at the time the stock was issued. This generally means its total gross assets were $50 million or less at all times after August 9, 1993, up to and including immediately after the stock was issued.
$50 million asset test ensures it's actually a small business.
4, you must have acquired the stock at its original issuance or from an underwriter in exchange for money, property, not other stock, or as compensation for services. There are exceptions for acquiring it via gift, inheritance, or conversion from other QSB stock.
Original issue, so buying it on the secondary market later usually doesn't count.
Generally, no. You need to get it directly from the company initially. 5, and this is ongoing. During substantially all of your holding period, the corporation must have met the active business requirement. This means at least 80% by value of its assets were used in the active conduct of one or more qualified trades or businesses.
Okay, qualified trade or business. That sounds like another key definition. What kinds of businesses don't qualify?
Right. This excludes many service-based businesses. A business is not qualified if its principal asset is the reputation or skill of its employees or if it's involved in health, law, engineering, architecture, accounting, actuarial science, performing arts, consulting, athletics, financial services, brokerage services, banking, insurance, financing, leasing, investing, farming. Businesses operating hotels, motels, restaurants, certain mining or natural resource extraction businesses.
So a software company, a biotech firm, a manufacturer, those might qualify. But a law firm, a consulting group, a restaurant chain, probably not.
That's generally the idea. It's aimed more at businesses developing products or technology, rather than primarily providing services based on skill or reputation.
This is incredibly valuable info for anyone investing in or starting a C Corp. Assuming you meet all these tests and hold for over 5 years, how do you report this amazing exclusion on your tax return?
You report the sale on Form 8949, Part 2. Since it must be held over 5 years, it's long-term. You enter the details as usual. Then the magic happens in columns F and G. You enter code Q in column F. And in column G, you enter the amount of the gain you are excluding as a negative number, in parentheses.
Code Q for QSB. And the negative number subtracts the tax-free portion.
Precisely. It reduces your taxable gain accordingly. Now, it's worth noting that for the 50% and 75% exclusions, stock acquired before September 28, 2010, a portion of the excluded gain used to be an adjustment for the alternative minimum tax, AMT, but tax law changes have mostly eliminated that concern for the 100% exclusion. However, the taxable portion of gains subject to the 50%, 75% rules might still interact with the 28% rate gain worksheet.
Okay, still some complexity there for older stock. Now, what if you sell QSB stock after holding it for, say, 2 years? You don't get the exclusion yet, but maybe you want to reinvest in another QSB. Is there a way to defer the gain, like a 1031 exchange?
Yes, there is. It's another powerful tool called the Section 145 rollover. If you sell QSB stock that you've held for more than 6 months, you can elect to postpone or defer, recognizing the gain, if you purchase other QSB stock within 60 days, beginning on the date of the sale.
Hold on, more than 6 months holding, not 5 years. And you buy new QSB stock within 60 days.
That's right. Section 145 lets you roll over the gain much sooner than the 5 years needed for the Section 1202 exclusion. You only recognize gain to the extent that the proceeds from the sale exceed the cost of the replacement QSB stock you buy.
So if I sell QSB stock A for a $100K profit after 2 years, and within 60 days I reinvest the full proceeds plus the profit into QSB stock B, I pay no tax now.
Correct. In that case, the $100K gain is deferred. Your basis in the new QSB stock B,
Yeah.
would be reduced by the $100K deferred gain. So the gain isn't gone, it's just pushed down the road, embedded in the new stock's basis.
That's a fantastic way to stay invested in the small business sector without triggering immediate tax. How do you report this rollover?
You need to make an election, usually by the due date of your return for the year of the sale. On Form 8949, Part 1 or 2, depending on the holding period over 6 months, you report the sale, use code R in column F, and enter the amount of the postponed gain as a negative number in column G.
Code R for rollover. Makes sense. Are there other similar exclusion or deferral programs tied to specific locations, like enterprise zones or the newer opportunity zones?
Yes, Congress has created several geographically targeted incentives. There was an exclusion for gain on certain DC zone assets, District of Columbia Enterprise Zone, held over 5 years, acquired generally between 1998 and 2011. Similar rules existed for qualified community assets and designated renewal communities for assets acquired mostly between 2002 and 2009.
Those sound like older programs. What about the newer opportunity zones?
Right. The Qualified Opportunity Fund, QOF program, is the major current geographically targeted incentive. This one is different because it's primarily a deferral mechanism, potentially coupled with an exclusion later.
How does the QAF deferral work?
You can take an eligible gain, which can be any capital gain, short-term or long-term, from selling stock, real estate, anything. And if you invest that gain amount into a qualified opportunity fund within 180 days, you can elect to defer recognizing that original gain.
Deferred until when?
The deferral lasts until the earlier the date you sell or exchange your QF investment, or December 31st, 2026. So you'll eventually have to pay tax on that original deferred gain, but potentially not for several years.
Okay, so it buys you time. Is there any other benefit besides deferral?
Yes, a potentially huge one. If you hold your investment in the QOF for at least 10 years, then any appreciation on the QOF investment itself can be permanently excluded from capital gains tax when you sell the QOF investment.
Wow. So defer the initial gain and then potentially get tax-free growth on the new investment after 10 years.
Exactly. It's a powerful combination. A QOF is an investment vehicle, a corporation or partnership set up specifically to invest in businesses or property located within designated low-income opportunity zones across the country.
How do you report the QOF deferral?
It's a bit more involved. You first report the original gain as you normally would on Schedule D Form 8949. Then you file Form 8949 again to report the deferral election itself. Critically, you also need to file Form 8997, initial and annual statement of QOF investments, each year you hold the QOF investment and when you finally dispose of it.
Okay, Form 8997 is key for QOFs. We've covered some major strategies, but the tax code is vast. Are there other, less common, but maybe interesting situations with special capital gains treatment we should briefly mention?
Oh, definitely. The instructions are full of specific rules. Just a couple of quick examples to show the variety. Virtual currency, like Bitcoin. The IRS treats it as property, not currency. So selling it triggers capital gains or losses reported on Schedule D, just like stock. Basis tracking is crucial. Section 1244 stock, or small business stock, a different provision than QSB stock. This is fantastic if it applies. If you have a loss on Section 1244 stock issued by a qualifying small domestic corporation, individuals can treat up to $50,000 of that loss, $100,000 if married, filing jointly, as an ordinary loss instead of a capital loss.
Ordinary loss again. That bypasses the $3,000 capital loss limit.
Exactly. It's a huge benefit for losses on investments in qualifying small businesses. Any loss above the $50K, $100K limit is still a capital loss. You report the ordinary loss portion on Form 4797 and any capital loss portion on Form 8949 using code S.
It really feels like every niche has its own rule. Okay, let's switch to practical filing tips. Making the process smoother. A simple one first. Rounding. Can I just round everything to the nearest dollar?
Yes, you can. The IRS allows you to round cents to the nearest whole dollar on Schedule D and its related forms. If you choose to do it, you have to be consistent and round all the amounts reported.
How does the rounding work? 50 cents rounds up.
Yep. Drop amounts under 50 cents, increase amounts from 50 cents through 99 cents to the next dollar. So $12.49 becomes $12, but $12.50 becomes $13. It just makes the forms look a bit cleaner. One small note, if you're adding several numbers together to get a total for a line, add them with the cents included first, and then round the final total.
Good tip. Now, earlier you mentioned a potential shortcut, Bypassing Form 8949 for some transactions using lines 1A and 8A on Schedule D. That sounds like a great time saver. Tell me more.
It really can be, especially if you have a lot of simple stock trades. This is the simplified reporting method. For certain transactions, you can aggregate the totals and report them directly on Schedule D, line 1A for short-term or line 8A for long-term, without having to list each one individually on Form 8949 and without attaching any extra statements.
Okay, I'm listening. What are the conditions? When can I use this glorious shortcut?
You can use it only if all the following are true for the transactions you want to aggregate. 1. You received a Form 1099-B or substitute statement that shows your basis was reported to the IRS. Usually this means Box 12 on older forms, or a similar indicator on newer 1099-Bs is checked.
Yeah.
2. The ordinary box, Box 2 on the 1099-B is not checked. 3. The QOF box, Box 3 on the 1099-B is not checked, and you're not doing anything related to QOF deferrals for this transaction. 4, and this is the big one, you do not need to make any adjustments whatsoever to the basis, the gain-loss amount, or the type of gain-loss reported on the 1099-B.
No adjustments. So that means no wash sales, no QSB exclusions. The 1099-B has to be perfectly accurate as is.
Exactly. If the 1099-B shows the correct proceeds, the correct basis reported to the IRS, and there are no complicating factors like wash sales, QSB rules, related party issues, collectibles, etc., then you can likely use the simplified method for that transaction.
How does it look on Schedule D then?
Let's say you have 3 long-term stock sales that all meet these conditions. Sale 1, $5K proceeds, $2K basis. Sale 2, $8K proceeds, $3K basis. Sale 3, $1K proceeds, $500 basis. All head basis reported to IRS, no adjustments needed.
Okay.
Instead of listing these 3 on Form 8949, you just go to Schedule D, line 8A. In column D proceeds, you enter the total. If I say it's 8K plus 1K plus $14,000, in column E basis, you enter the total. 2K plus 3K plus $500, $14,000. In column each gain loss, you enter the net gain. $14,000, $5,500, $8,500.
Yeah.
Done much faster.
That is much faster. So
Yeah.
when am I forced to use Form 8949 instead?
You absolutely must use Form 8949 if basis was not reported to the IRS on your 1099-B. If that box isn't checked, it goes on 8949. Or if any adjustment is required, if the basis on the 1099-B is wrong and you need to correct it. If it was a wash sale, code W. If it was QSB stock, code Q. If it was a non-deductible loss, code L. If you need to make any change to what the 1099-D shows or apply a special rule, it needs the detailed breakdown provided by Form 8949.
Okay, so 8949 is for anything non-standard or needing adjustment. For those standard transactions reported on 8949, feeding into lines 1B, 2, 3, 8B, 9, 10 on Schedule D, how is the gain-loss calculated there?
It's straightforward math. On each line of Form 8949, you take proceeds, column D, minus cost basis, column E. Then you add or subtract any adjustments shown in column G. The result goes into column H, gain or loss. Schedule D then just sums up the column H amounts from the relevant sections of Form 8949.
Right. Now, sometimes those calculations get more complex, leading to special worksheets, correct? We touched on them earlier. Let's revisit the main ones. The 28% rate gain worksheet for Schedule D, line 18. Why is this needed?
This worksheet isolates certain types of long-term capital gains that are subject to a maximum tax rate of 28%, which is higher than the usual 0%, 15%, 20% rates. You generally need to complete it if you have long-term gains from selling collectibles, or if you had a Section 1202 QSB stock exclusion under the older 50%, 60%, or 75% rules. Part of the taxable gain might be 28% rate gain.
Remind me what counts as a collectible again.
Things like art, rugs, antiques, metals, gold, silver bullion, gems, stamps, coins, alcoholic beverages, and certain other tangible personal property specified by the IRS. Gains on these held long-term get potentially taxed at that higher 28% rate.
Okay. Then there's the unrecaptured Section 1250 gain worksheet for line 19. This was about real estate depreciation.
Exactly. This applies if you sold real property, like a rental house or office building, that you held for more than 1 year and had claimed depreciation deductions on. Section 1250 refers to the tax code section dealing with depreciation recapture on real property.
And the recapture part is taxed differently.
Yes. A portion of your gain, up to the total amount of depreciation you previously claimed, can be taxed at a maximum rate of 25%. This is the unrecaptured Section 1250 gain. This worksheet helps figure out that amount, which then flows to the final tax calculation. It often arises from sales reported on Form 4797 or from REIT dividends reported on Form 1099 DIV Box 2B.
So collectibles at 28%, depreciation recapture at 25%. This leads us to the final calculation tool, the Schedule D tax worksheet. This puts all the pieces together.
Pretty much. If you have regular long-term capital gains, taxed at 0.1520%, and you also have these special rate gains, collectibles at 28% from line 18, or unrecaptured 1250 gain at 25% from line 19. The Schedule D tax worksheet is what you use to calculate your overall tax liability correctly.
How does it do that?
It essentially breaks down your taxable income into different buckets: ordinary income, 20% rate gain, 25% rate gain, and regular long-term gain-qualified dividends, and applies the correct tax rates to each bucket. It ensures you get the benefit of the lower long-term rates where applicable, while still paying the right tax on the special rate gains.
So it prevents the higher tax gains from somehow bumping your regular long-term gains into a higher bracket.
Exactly. It sequences the calculation properly. You generally don't use this worksheet if your capital gains are 0 or less, or if your overall taxable income is 0 or less. But for most people with a mix of income and capital gains, it's the necessary final step to figure the tax.
Okay, that makes sense. And finally, let's just hammer home that capital loss carryover one more time. If my Schedule D for 2024 ends up showing a net loss bigger than $3,000,
Then you absolutely carry that excess loss over to your 2025 tax return. Don't let it disappear. It's a valuable asset that can reduce your taxes in future years, offsetting future gains, or up to $3,000 of ordinary income each year until it's used up.
keep those records, use that carryover worksheet next year.
That's the key. Meticulous records and utilizing that worksheet are essential to maximizing this long-term tax benefit. It's all about being proactive.
Wow. We have covered an incredible amount of ground today, diving deep into Schedule D, from the feeder forms like 8 and 949 to defining capital assets, the crucial short-term versus long-term distinction.
And importantly, hitting those powerful tax-saving strategies. The home sale exclusion, QSB stock rules, QOF deferrals, trader tax status, maximizing loss deductions. These aren't small things. They can make a huge difference.
It really drives home that understanding these forms, these rules, isn't just about compliance. It's genuinely about smart financial planning, smart investment strategy. Knowledge here really is power, wouldn't you say?
Absolutely. It shifts your perspective from just reacting to tax rules to actively using them to your advantage to improve your after-tax outcomes.
So a final thought for everyone listening. We've seen how specific transactions, holding periods, asset types all have these unique, sometimes surprising tax implications hidden in the instructions. What other common financial moves might you be making where similar significant tax-saving provisions could be lurking, waiting to be understood and utilized? It really shows the more you dig in and understand, the more you can strategize rather than just, filling out the forms and hoping for the best.